The yield on the 10-year U.S. Treasury back above 4%. Our bond bulls about to get hammered again. Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Jim Bianco, president of Bianco Research. Hi, Jim. Welcome to the program.
Thanks for having me, Maggie.
So, wow, we had a lot of movement, especially at the end of the day. Treasury yields higher. We mentioned above 4%. We had oil up again, almost 4% on the session. The VIX up again, double digits, stocks down by 1%. And we saw selling picking up into the close. What do you make of the market action today? What's going on?
I think there's two things going on in the markets. I think, first of all, there's still the worry about what's going on in the Middle East. There's that concern that there's a retaliation coming, and what does that mean? Are they going to go after oil facilities or not? And is that going to disrupt the oil flow? I think there's also a concern now that Hurricane Milton is looking like it could be one of the most devastating and damaging hurricanes in American history, and that there's going to be a lot of property loss. And the insurers have been getting smashed on that news right now. Part of that might be that, if there's going to be tens of billions of dollars worth of property damage, the insurers are going to have to sell tens of billions of dollars worth of treasuries because they got to pay for this stuff. That's always been a case every time there's been something like this. And then I also think that there's a residual from Friday. The payroll report on Friday really was a bit of let's call it a mini game changer. And let me explain. The market was settled in. The Fed was going to cut the funds rate to 3%. So settled in was the market, and I think a lot of people don't realize this. It was already priced into the bond market. Mm-hmm. And I was joking with my friends that, so if the Fed cuts to 3%, you do realize the 10-year Treasury is going to be unchanged for 200 days in a row because it's all priced in.
Yeah.
And the 10-year yield, if the yield curve steepens, means it's got to go up in yield because it's all priced in. Then we got a strong number. And then the market's like, well, maybe they're not going to go to 3%. They're going to go to 3.5%. Well, that's why we've seen yields really back up a lot. Okay, we overshot. And now we have to start thinking about the Fed not cutting as much, and interest rates are moving higher. So you've got a confluence of events coming into the market. By the way, I didn't mention anything about the election. I don't think that's yet in play yet in the market.
Which is incredible. And it just speaks to the headline risk, I think, that's out there, Jim, with all of these events. Let's talk a little bit about each of them. And, you've been arguing for a long time that people were underestimating the U.S. economy, that it was stronger than many have assumed. Why have so many gotten this wrong? And it's important because it feels like we're having another one of those bond trades again. It's been so painful. People keep running yields down, thinking that slowdown's coming. We finally got the Fed cuts, but that continuation of it doesn't seem like it's the case. And it could be another really painful sell-off in bonds again. I mean, there are people who've just gotten smacked on this multiple times over the last few years. Why does this keep happening?
I think there's two big picture and then maybe a micro picture. The bigger picture is I've argued that the economy has changed coming out of 2020. That is something that I think is still being debated in market circles and in economic circles. Is this a different cycle? Now, Chairman Powell does not think it's a different cycle. He constantly talks about the economy normalizing, going back to pre-pandemic levels. And I said, look, that's the old cycle. We're not going back there. We're going to go to something different. And that something different is going to be a stronger nominal growth economy, and then throw into that nominal inflation. And that if we're going to have a little bit more inflation, the problem is if you still, and look, maybe I'm too online, but I still hear people thinking about, no, the Fed's going to cut rates to zero. Nope, that era is over. That era is over. They're not going to be cutting rates that much. And if they did, all they're going to do is produce 7, 8, 9% inflation. They're not going to produce a stronger economy. So I think that that's part of it. And then I think the other part, I did tweet this out earlier today, and I've been tweeting this out semi-regularly. One of the strongest relationships with the 10-year yield is crude oil. And crude oil prices go up and down with the 10-year. Now, we could debate which one causes and which one affects. Everybody assumes it's crude oil prices move and interest rates impacted. It could be the other way around. But crude oil prices are up a lot now, 16%. And that's got yields up too. So I like to say, maybe what we did from April until, early September was we mistake the fall in crude oil prices for a bull market in bonds. And then as soon as the fall in crude oil prices ended, so did supposedly the crude oil, the bull market in bonds.
Yeah. And that's a huge move, that 16% for anyone watching inflation, and a lot of credit to some of the guests we've had on who kept saying, wow, it seems really lopsided. This market doesn't seem like it's factoring all the risks out there, and then including the geopolitical ones we see. And then wham, 16% in just a really short period of time certainly complicates things for the Fed. Are we going to start to see that reflected in inflation numbers? Is the market ready for that, Jim? We'll do
I don't think
X
it's,
energy. We know they're going to look at
yeah,
core, so I guess it'll be
right,
easy to.
right. I mean, I think what you're going to see is if you look at the base effect in inflation, a year ago, the inflation numbers were the inflation numbers, the headline inflation numbers were 4/10. The headline inflation numbers are expected to be 1/10, and that's all energy is what that is. A year ago, the price of crude oil was $95. In September, the price of crude oil, because that's the number we're going to be getting, was going straight down. The 16% rally happened literally started September 30th into early October. So you're going to probably see the year-over-year number go to 2.3 on the headline, but the core number, that's going to be another interesting one because you could see a 0.3 on the core number, keeping it above 3%.
Mm.
And if it is, I've argued that the seasonality is going to start turning north on inflation, and when all is said and done, we never got it under 3%. I'm talking about year-over-year core CPI,
Mm.
PCE. We never got under 2.5%. And these were numbers that were considered unacceptable before 2020. And now these are numbers that we're getting and we're saying victory. And really, we're just saying victory right at the low, as I think that inflation is going to start heading higher. And add into that the stimulus of the Fed cutting, pushing stock prices higher. Remember, it was just a couple of days ago. Friday, the Dow made a new all-time high. And it was just a couple of days ago the S&P made a new all-time high. So I think all of that is just going to keep feeding into this narrative, and that it's going to keep interest rates on a trajectory higher.
Yeah. Hi to everybody in the chat. It's great to see you all. And Jim, they've already peppering with some questions, and I want to get one of them in. Hi, Tommy Thornton. He says hello to us.
Hey,
He's here as well.
hello, Tommy.
So Boris is asking, my question to Jim, the 10-year yield curve showed quite a remarkable steepening over the last few weeks. Do you think it was just a short episode of a normal shaped yield curve going inverse again?
No, I don't think so. I do think that the yield curve has finally started to move onto the track of steepening. Now that I've said that, of course, it reinverted today, that yield curve. It's been going the other way as the 2-year note has been pricing in less Fed rate cuts. But I think that the yield curve is going to continue to steepen, say, into the first quarter. Now, here's the problem. If the yield curve normalizes, what does that mean? That means that the 2-year and the 10-year usually trade. The 10-year trades about 100 basis points above the 2-year. That's the average yield curve that we've seen over the last 40 years.
Mm.
Well, if the 2-year note's at 4% right now, where's the 10-year supposed to trade? 5. It's supposed to trade 5, the level that is considered to be impossible by a lot of people. Otherwise, you'd have to make the case that the curve is going to stay either flat or somewhat inverted. I don't think it is. I think we're in the process of uninverting and steepening the curve now. And it's going to be very volatile because we're also in a process of a Fed rate cut cycle. And that also adds in a lot of uncertainty. That's why what you saw was 4 days ago, the yield curve was positive 20 basis points. Then we get a strong payroll number. The Fed's got to take out one or two or the market's got to unprice one or two Fed rate cuts. And the 2-year shoots up and now we're inverted again. But you could see that as that curve continues to move, going more positive, that's a nice way of saying that the 10-year yield keeps going higher.
Yeah, which is bad news if you were someone who is expecting, a bull market for bonds here. What can the economy handle a 5% 10-year?
I think it can, and I think it has. July of 23, The funds rate went to 5. The funds rate got cut in September of 24. Stock market was up 23% during that period. I think what people need to understand is this is no longer the quantitative easing period of 2009 to 2022. This is no longer the zero interest rate period. That era is over. You could send it, I like to joke, you could send it to the historians, not even the economists, because we're not going back to that era. If you look at the era before that, pre 2009, we had bull markets, we had people employed, we had the economy growing, and we had 4, 5, 6, even 7% interest rates. This economy can handle that level of rates. Problem is, most people are not equipped to, they're anchored to that QE period. They think that's normal. That was the abnormal period. This is closer to normal in terms of interest rates. And I think that, yes, the economy has handled it. We've been seeing, we're still at 4% on unemployment. We're still growing at 2 to 2.5% on GDP. We are still seeing the stock market go up. We're still seeing credit spreads narrow. You'd be very hard pressed, unless you're a mortgage broker, to tell me that there's any pain out there because of these rates. And if you're a mortgage broker, you're right, your industry is getting hurt by these rates, but sorry, it's not big enough to move the needle. We don't cut rates because the refi index is not up high enough. And so that's why I do think that these rates are somewhat normal. We're just not used to it yet.
So, a comment question in the chat. More pain for REITs if capital costs stay elevated. Doesn't the market eventually need lower refinancing costs? And yes, Friday I was speaking to Harry Melandri, who was also just wondering. I just asked him to sort of give me a few chess moves out. What are things that you're thinking about that maybe people are not paying attention to right now? And, we forgot all about commercial real estate, right? Because it's extend and pretend, and it's not on bank balance sheets, it's on private. But are any of those things an issue if you start to get a more normalized, higher interest rate environment, Jim?
No, I'm going to push back and say no. I'm going to say that commercial real estate has its own set of problems that interest rates cannot fix. In fact, could make worse.
But that's what I mean. Can't fix them, but can they make them worse
by having higher rates? No, I think lower rates makes it worse.
Oh, really?
I think that lower rate, look, there's a lot of bad commercial real estate. There's a lot of bad office properties. It is time that we understand that they are bad and they get restructured. And if the answer is whine like a 5-year-old to give me zero rates so I can keep this crappy property alive for another 2 more years, that is not doing anybody any good. And I think that if your project cannot survive in a 5 or 6% mortgage world, then your project's not viable, because that's the world that we are in right now. And I think that this is the problem with every cycle is the people in this cycle in the mortgage market are people that only know how to make projects work with 0 to 2% interest rates. And, they took over for the people that would only make projects work in an 8% interest rate world. The 8% interest rate world was far more conservative. The 0 to 2% interest rate world was far more aggressive. And now we've got to basically restructure that whole industry. And zero rates isn't going to fix it. It's going to make it worse. Higher rates is what this economy is about right now. This is a pre-2009 economy. This is an economy when we looked at 5% or 6% 10-year notes and said, yeah, that's kind of what they are. Where's the story? Today, we look at that and we're all breathing in brown paper bags, freaking out because we can't believe that rates are that high. We got to get used to that. And this is the problem, I think, that we're facing right now. These rates are not restraining anything except at the margin, some real estate. But like I said, it's not enough to move the needle, because if you cut rates to spur refis, if you cut rates to do that stuff, you're going to spark inflation. One of the quick things about the housing market, we all talk about that the housing market's in trouble. Starts are down, sales are down, affordability is down. It's very hard to afford a house. But what isn't down? Prices. Prices are at an all-time high. Now, why are prices at an all-time high if everything else is bad? Shouldn't they be down too? I think the answer actually is the population growth of the country has exploded higher in the last 4 years because of migration.
Mm.
We have between 7 and 15 million more people in the country now than we had 2020. That means they need somewhere to live. That's the population of Georgia is 11 million people. That's another state of Georgia that we've kind of created, and that's creating a shortage of housing, and that's keeping prices higher. You want to cut rates and you want to spur another wave of buying. Wait till you see what house. Look, I'm a house owner. I got 3 adult kids that are renters. Screw them. I want you to cut rates, and I want you to put another 30% on my house because I'm being very, very myopic in my thinking. All you're going to do is produce housing inflation in that regard. If you cut rates and you unleash another wave of buying on a market that is already short of housing units to begin with right now, and it is not going to get fixed by interest rates. It's going to get fixed by restructuring the market. The other problem too is, guess where the population is somewhat stabilizing and growing again? In the Northeast and the Midwest, because that's where all the migrants are going. Where are 83% of all housing starts created? In the South and the West.
Yeah.
So what's happening is all the migrants are coming into the country. They're put on a bus. They're sent to New York City. They're sent to Chicago or Philadelphia or Boston. They got nowhere to live. No one's building houses there. But don't worry, we're going to start another project in Orlando and Las Vegas. They're not going to Orlando and to Las Vegas. This is why this market is all out of kilter right now. And I don't think lower interest rates fixes it. I think it has bigger issues than just interest rates.
I love your point about, at some point there has to be some restructuring and these stranded assets have to be dealt with, right? And so if you're in an environment where you could just extend the sort of zombie commercial real estate properties, you don't resolve it. You don't move on. Tommy Thornton with a question comment: if the 10-year was at 5% with the Fed cutting, wouldn't the Fed seem as if they'd lost control of the bond market?
Yes, yeah, that would be the case, because if the 10-year, that's a long way away now, 5%. But what rising rates mean after the Fed cuts is a rejection of the policy. It is a signal that the policy is a mistake, and that the fear is it's producing inflation, or it's stimulating the economy too much. Is where that is what it suggests. Now, it's fair to say it's not uncommon for when the Fed starts to rate cut, you get a backup in yields. That's true. This has been a large one, though. And so some bond bulls would say to me, yeah, this kind of happens after the first rate cut. They kind of go up, but then they settle out and they come right back down again. That's true. Historically, that's been the case. But this one has been much bigger than what we've seen in the past. Now, part of the reason that it's much bigger is because typically when the Fed starts cutting rates, we're already in recession. There's no recession. There is no stock market 15 or 20% off the high. There, like the last couple of rate cuts cycles began, is when when the stock market was in trouble and we were already in recession. So we're not, I don't think that we're necessarily following the old script, although you could technically say the old script is the Fed cuts, rates go up. But this one, they're going up a lot more. And I think that if they continue to move higher, the conclusion is the Fed is giving us stimulative of policy when the market's saying it doesn't need it. And it's just going to produce bad outcomes, malinvestment and inflation.
Jim, you made a really interesting point that I hadn't heard. And of course, we're just wrapping our head around this hurricane. And there's some people in the chat, and I'm so happy to hear that some of you feel like you're out of harm's way. And of course, it's going to be a really, really tough couple of days for Florida on the heels of just getting hit. The insurance losses as something. So just walk us through that in case that scooted past people when we were talking just generally about all the things that the market has to deal with. We've always wondered about forced selling, right? If you've got to raise capital, do you sell your winners? Would it feel, do you think that's a sort of temporary, how much could that impact stocks?
I think it can impact bonds a lot more, but
Bonds,
you're right.
really?
Yeah, because the property and casualty insurers are more heavily weighted towards fixed income than they are towards equity. So the hurricane comes through and there's lots of property damage. And you have to keep in mind the way that this usually works with a natural disaster is that you will get adjusters on the scene before the rain stops, and they will give you a check 24 to 48 hours afterwards. There is no file a claim, argue about it for 6 months. No, you're going to get a check within 2 or 3 days, and billions of dollars of checks are going to go out the door, and they're going to have to raise cash in a hurry. And the fastest, easiest way to raise cash is in the most liquid market, and that's treasuries. And so that's why that's always been kind of the knee jerk reaction when you have big property damage type of events,
Hmm.
is that the P&C companies are going to wind up selling the liquid stuff like treasuries first. Whether or not they get down to selling their stock portfolios, or whether or not this means they're going to sell Nvidia, usually that's last on the list that they want to sell. But the stock market's not going to take kindly to rapidly rising interest rates or the bond market being under pressure. And
Exactly.
we have no idea how bad this is going to be, because there's been some talk that it's a Cat 5 hurricane. It might be the largest hurricane to hit Florida since the Civil War. It's going to emerge on the Atlantic side, and it's still going to be a hurricane. It's going to turn north, and then it's going to hit somewhere else. And so by the time we're done with all of this property damage in 10 days to 2 weeks, it could be huge
Yeah.
at this point. Or maybe we get lucky, and
Yeah,
and
let's
you know
hope,
and
but
it
that Gulf is really warm, which is why I think people are growing very, very concerned.
right.
So let's rifle through a couple other issues that are on people's radar. So if we have higher interest rates, what does that mean for stocks? We saw when rates, if the 10-year were to get back to 5%, we saw a lot of people looking at their portfolios saying, I'm gonna take that yield. Maybe I don't want to be in risky assets. Maybe I don't want to be in stocks. Uh, could we see that again in terms of allocation? Or, there's been so much talk, this idea of 60/40, or even the role in bonds in a portfolio is up for question. How are you thinking about that?
Yeah, so two things. Since the October 2022 low, which was the 12th, so we're coming up on the second anniversary of the bottom of the bear market from 2022. There's been three 10% corrections, or 9 to 10% corrections. First one was October of 23 when we hit 5%. Second one was April of 2024, this year, when rates went to 475. Notice a trend there. Rates go up, the stock market gets bothered by it. The third one was the carry trade unwind in August, but that one was only a couple of days, and then it rebounded back to a new high. So normally the stock market seems, in this environment of the last 2 years, it gets bothered by high rates. Now, what is that magic level? Is it 405? Is it 450? Is it 5%? We don't know where that level is, but there's a level out there that when rates go high enough, it seems to bother the stock market. So it's like the stock market, it doesn't care, it doesn't care, it doesn't care. Now I care. It's basically what happens with the stock market. As far as bonds, you're right. Look, I've argued the 60/40 portfolio died, in 2022. What was the 60/40 portfolio? So everybody understands what I've defined it as, and other people have defined it as. You own stocks because they always went up, and you own some bonds, 40% of your portfolio, and they were low yielding 2% bonds, and they were effectively crash insurance. You owned them because when the stock market went down, you got a risk off rally, and that offset your losses. That's not been the case. That negative correlation between the price of bonds and stocks has been gone now for a couple of years. We're at the highest positive correlation between stocks and bonds, I think, in 18 years right now. They move up and down together. The new environment is more like the pre 2009 environment. Here we go again with that pre 2009 environment. Stocks, what should you expect out of the stock market? Dr. Jeremy Siegel wrote a new update to stocks for the long run. He said 8% a year is a reasonable expectation for stocks. Now, I know the crypto crowd goes, you mean a week? Because that's what they want. They want 8% a week. No, 8% a year. Okay, we're having a 20% year. So we're a little bit ahead of that number right now. The bond market is yielding somewhere, if you add in corporates and mortgages and everything else, in the high fours. So the bond market is giving you 2/3 of that potential, but the risk that the bond market has now that it has a 4 or 5% coupon, and now that the durations in the bond market are a little bit shorter, that even if rates went to 5 to 5.5%, you'd still have a positive return in the bond market. It might be 0.1. But if this stock market goes to 5%, if the bond market goes to 5% returns, the stock market might lose you 10 or 20%.
Mm.
The bond market might lose you 0 or maybe positive 1%. So what I'm arguing is that if you have your expectations adjusted properly, and most people don't, like I said, they want 8% a week. The bond market is now flat out competitive with the stock market. Lower risk, 2/3 of the return of the stock market right now. It should be part of a portfolio because of its coupon and what you should expect. Look, most wealth managers that are doing a good job would tell you, look, if you get year in and year out about a 7% return, you should be doing okay. Now, your core portfolio should be some stocks, some bonds, yielding, with an expectation of about 7-ish%. And then you have like a third of your portfolio, AI stocks, crypto, growth stocks, something more aggressive. Now, those might give you 200-300% returns, but they also might lose you half your money. But your portfolio should be bedrocked around about a 5 or 6 or 7% return. The hardest part about that is people look at that and go, that sucks. I want 20%. That is unrealistic at this point. That's always been somewhat unrealistic as we've moved forward from here. You have to be realistic about what the market gives you. Now, maybe you could argue that you want to be all in on AI stocks, you want to be all in on crypto. That's fine, but you might also wind up losing 2/3 of your money. If you're 65, I've always said too, a bear market has nothing to do with price. A bear market is time. If you're 65 years old and you go all in on an aggressive portfolio, and we have a bear market, don't worry. In 10 or 12 years, you'll be back to break even. Not good enough. That's 2/3 of my life expectancy. And I'm going to be at a worse financial position for the majority of my rest of my life. That's where bonds come in, and that's where they help. If you're 35 years old and you told somebody, wave them in, because at 45, I'm ready for that next 20-year run. And so but the problem with the world is 35-year-olds don't have money. 65-year-olds are the ones with all the money.
Especially increasingly what we just covered before. What about gold in that portfolio? And what about international stocks? We know China's stimulating a lot. We saw big moves in China. Do they have a place? Where would they fit in on your?
Yeah, so gold, I would argue that there's a signaling from gold too. Gold is actually what has been the best performing investment asset class over the last 4 months. It's not been crypto. It's not been, Mag 7 stocks. It's not been international stocks. It's been gold. Gold is up 30% over the last 4 months or so. It has been the top performer. What is driving gold? Gold goes when there's uncertainty, when there's a perception of bad things. Well, what are the bad things? We got the Middle East. We've got an election. We've got maybe aggressive monetary policy. I think it's aggressive monetary policies to change on the edge. So gold is a good hedge for all of that, and it has been working very, very well. International stocks, boy, tonight, in a couple of hours, the Chinese market is going to reopen after being closed for a week-long holiday. And this is going to be really interesting. It was up in 10 days. The Chinese stock market was up 25%. You have to go back to the 90s to find another 10-day period when nobody knew what the Chinese stock market was. It was a tiny fraction of what it is today, to find another 10% move. The Chinese government hit the panic button. Their economy's in deep trouble. They are cutting rates, changing reserve requirements, making it easier to acquire property. They're stimulating the economy so much that they're talking about having government workers walk around to the poor in Beijing and Shanghai and handing them cash, handing them money and say, here, go spend this so we can get our economy moving forward. It has produced a giant monetary pop. The stock market went vertical. Now the question is it going to produce an economic move? Sure, the numbers will sugar high for a quarter or two, but is it going to do something more than that? If it does something more than that, then this rally that we've seen in Chinese stocks can persist. If it doesn't, and it's just a sugar high, then this was just a rally to sell, is what it has been.
Yeah.
But the problem is, going into mid-September, Bank of America does their fund manager survey, and it basically showed that all the fund managers were short the Chinese market, were out, hated it. They were caught flat-footed when this thing took off, and they're all chasing it right now. And we'll have to see whether or not that turns out to be a good move or not, because they missed this move from the beginning and they've been chasing it ever since. I don't know. I have my doubts. The Chinese economy is in trouble. They are stimulating because they recognize they're in trouble. Is just handing poor people cash and saying, here's a bunch of crappy property, but don't worry, we'll make it easier for you to buy crappy property, the fix to a property problem? I don't think it is. So color me skeptical as to whether or not long-term this will work. But stranger things in life have happened. So let's see if we get any kind of signs that this is really marking a change in the attitude among the Chinese consumer, not necessarily among the Chinese stock investor. We know that they're all in on this thing, but they need the follow-up from the economy or it won't last.
Yeah, I think Lena in the chat put it really well. Chinese market is a trade, not a buy and hold. You have to stay really nimble and really understand your risk profile, I think, if you're going to dabble in that. Jim, we got to go, but I feel like we barely scratched the surface, as always, with you. So hope to see you again soon. But thank you so much. It gave us a lot of stuff to think about.
Thank you.
Thanks, everybody. Thanks in the chat. Remember, subscribe to the channel if you have not. Yes, Tommy Thornton is coming on. I don't know the date right now. The 23rd, he'll be on, which we're looking forward to. And we're going to talk about tech and AI come Wednesday. So join us for that. So thanks, everybody. As always, take care and good luck out there.